Back to Fast Stock Market News, where I give you all the news as fast as I can. So today, guys, was a pretty choppy day in the market. Overall, we finished a little bit higher for the index, the major indexes, and there were a couple of drivers driving today's price action, and I'll get to that right now, guys. As we can see, the S&P 500 finished 0.36 in the green, the Dow finishing 0.23% in the green, the Nasdaq finishing 0.35% in the green, and the Russell finishing about negative 0.8 in the red. There's a reason the Russell didn't finish a little bit higher as opposed to the rest of the indexes, and I'll explain that to you guys right now. So the first thing is, if you watched my video a couple of days ago, I did mention about how the mortgage demand is a big thing right now. It needs to come down a lot lower in order for this economy to get fixed and inflation to get fixed as well. And as we saw, I did mention this to you guys a couple of days ago, that the 30-year fixed mortgage had to come down, and sure enough, it fell 0.10%, 0.1%. So that's good news overall for the housing market. We need the mortgage rates to come down, and also to loan applications to come down as well. So this was one of the first drivers. It kind of made us, I guess, sell off a little bit at the start of the day, but then the market rallied toward the end, and that's the reason. The reason it rallied was basically because the Fed re-emphasized something, and I'd have to say this over and over again, guys. It's not new news, but the market is some kind of like algorithmic. Whenever the Fed posts something, interest rates, algorithms, they just trigger, and buying and selling happens. It's a very strange dynamic that happens right now with the new age markets. So anyway, he basically reiterated that the Fed, the FOMC minutes said that they're going to continue with the interest rates in July, which we knew for like a month now. And 2 months ago, we knew this information too, but the market's like clarity. And they said they're going to do about 50 basis points to 75 basis points. So, and you go back real quick to why the Russell didn't rally higher as opposed to everyone else, because the Russell's companies are full of non-profitable companies. The Nasdaq has some, but overall, big tech carries the Nasdaq, and they're very profitable companies, along with S&P, the Dow, all profitable companies, because the Russell is basically the Fed continues to raise interest rate. The Russell has a lot of non-profitable companies, and this causes the companies to have more liquidity issues. So that's kind of like the only reason this was the only one that didn't rally higher. And to get more clarification on the Fed minutes, CNBC broke the news today, and I wanted you guys to have a look.
Well, the minutes of the latest Fed meeting show that officials agreed that another rate hike of 50 to 75 basis points would likely be appropriate at its meeting later this month. Officials also acknowledge that there could be an even more restrictive stance that could be appropriate if inflation remains high. Now, the minutes show that Fed officials were worried about inflation becoming entrenched. That was debated several times in this document. Many participants viewed that as a significant risk. Now, officials believe that the Fed's credibility had helped shift market expectations toward a tighter policy stance, and they viewed raising rates as required to meeting the central bank's legislative mandate. Now, Fed officials also repeatedly highlighted the disparate impact that inflation is having on low and moderate income households. Officials also noted there could be some clouds on the horizon as well. Some pointed out that the pressure for additional wage increases appears to be receding. There were anecdotal reports as well of consumer sales starting to slow and businesses delaying investments because of rising costs. Now, officials said that low and moderate income households are spending more of their budgets on food, energy, housing, all sectors that have been strongly impacted by those rising prices. But they also stressed that persistently high inflation could stand in the way of achieving their maximum employment mandate. Still, the committee did acknowledge that higher rates could result in slower economic growth and dampen the labor market. That is why the Fed removed language in the statement that indicated the Fed could both return inflation to 2% and deliver a strong job market. So, guys, that's just a sign that Fed officials are acknowledging and understanding that that soft landing could be very difficult to pull off.
Hey guys, the biggest drivers driving the market today. Thanks again for watching the video, and I'll see you again tomorrow. Take care, everyone. Thanks again, everyone, for watching Fast Stock Market News. If you enjoyed the video, consider subscribing, commenting, or liking the video. I would greatly appreciate it. My name is Gio, and I'll see you tomorrow, guys. Take care.